Listen, I am going to tell you something right now that is going to change the way you think about investing. I'm Kevin O'Leary, and I didn't build my wealth by following the crowd. I built it by knowing when to strike, by understanding value when everyone else is panicking, and by having the discipline to put my money where my mouth is. And right now, today, I'm going to share with you the two stocks I would buy without hesitation. Not tomorrow, not next month, but right now if I had fresh capital to deploy. But before I get into the details, I need you to do something for me. If you're serious about building wealth, if you want to learn how to think like a real investor, and not just some amateur playing with their retirement account, you need to subscribe to this channel right now. Hit that button. Join the community because what I'm about to share with you is not some get-rich scheme. This is real money, real strategy, and real results. And I need to know you're serious about this journey. Now, let me set the stage for you. That's when the real opportunities present themselves. Fear is the best friend of the disciplined investor. They think it's gambling, they think it's about luck. But let me tell you something, luck has nothing to do with it. And most importantly, it's about buying those companies when they're on sale, not when everyone else is excited about them. I know what makes a company successful. I know what separates the winners from the losers. And the two stocks I'm going to tell you about today, they have everything I look for. They have moats, they have cash flow, they have dividends, they have management teams that understand capital allocation. These are not speculative plays. These are not some tech startup that is going to revolutionize the world but has never made a dollar of profit. These are real businesses with real earnings. Let me ask you a question. When was the last time you actually looked at a balance sheet? When was the last time you calculated a price-to-earnings ratio? When was the last time you thought about dividend yield and how it compounds over time? Most people never do this. They just buy whatever some talking head tells them to buy on television, or they follow some guy on social media who's probably living in his mother's basement. That's not investing. That's just noise. I'm going to cut through all of that noise for you today. I am going to give you the same analysis I would give to my own family if they asked me where to put their money. Because here's the thing. I don't waste my time on bad investments. My time is too valuable. Every dollar I invest has to work for me. It has to generate returns. It has to grow. And if it doesn't, I get rid of it. That's the discipline that separates wealthy people from everyone else. The first thing you need to understand about my investment philosophy is this. I am a dividend guy. I love dividends. I love cash flow. I love getting paid while I wait for the stock price to appreciate. You know why? Because dividends are real. You can't fake a dividend. A company that pays a dividend has to have real cash coming in the door. They can't just show you some fancy chart about future growth. They have to write you a check every quarter. That's accountability. That's proof that the business model works. And in this environment with all the uncertainty out there, with all the volatility in the markets, dividends are your safety net. When the market drops 20%, and trust me, it will at some point, you're still collecting those dividend checks. You're still getting paid. And if you're smart, you're reinvesting those dividends and buying more shares when everything is on sale. Now, I know what some of you are thinking. The tortoise beats the hare every single time when it comes to building wealth. This is non-negotiable for me. I need to see a track record of a business flexing its pricing muscle and customers happily paying up because the product or service is just that good or that essential. Number two, I need a fortress balance sheet. I don't want companies loaded up with debt. When interest rates are rising, debt is a killer. It eats into your profits and restricts your ability to invest in growth or return capital to shareholders. I'm looking for companies with low debt-to-equity ratios and tons of cash on hand. Cash gives you options. It allows you to make acquisitions, buy back stock, or increase your dividend, all of which are great for shareholders. And finally, number three, I want to see a history of dividend growth. It's not enough to just pay a dividend. I want to see a company that has a culture of increasing that dividend every single year. That tells me management is committed to rewarding shareholders and they are confident in the future of the business. A company that has raised its dividend for 10, 20, even 50 consecutive years is a company that has been through multiple economic cycles and has come out stronger every time. That's the kind of business I want to own. People will always need toilet paper, laundry detergent, and toothpaste. These aren't discretionary purchases. And brands like Tide, Charmin, and Crest have such dominant market share that P&G can raise prices and people will pay them. It's in the financial sector, a space many people are scared of right now. And here's the kicker. While everyone else is worried about regional banks, Blackstone is quietly consolidating its power and printing money. It's a financial powerhouse that is misunderstood by the market, which is why it's a fantastic opportunity today. So there you have it. Procter & Gamble and Blackstone. One is a stable, defensive consumer giant. The other is a high-growth financial titan. Together, they represent a balanced approach to investing in this market. They both have what I look for: pricing power, strong balance sheets, and a commitment to shareholder returns through dividends. This isn't just about two stocks. It's about a mindset. It's about learning to tune out the noise, ignore the fear, and focus on what truly matters: buying quality businesses at reasonable prices and letting them work for you over the long term. This is how real wealth is built. It's not a secret. It's just discipline. Thanks for watching. If you found this valuable, make sure you're subscribed and hit that like button. It tells me you're serious and that you want more content like this. Drop a comment below and let me know what you think of these picks. I read them all. Now go do your own homework, but remember my advice: invest like a shark. Thanks for your time. Remember the golden rule: boring makes money, exciting often loses it. They are so deeply embedded in how the world works, how businesses operate, and how we live our lives, that they become almost like a utility. These tech titans don't just survive economic downturns, they thrive in them. They use downturns as an opportunity to absolutely crush their competition. While weaker, cash-poor firms are struggling to make payroll, these leaders are busy buying back their own shares at a discount, acquiring smaller competitors and pouring billions into research and development to widen their competitive moat. When a company is generating tens of billions of dollars in free cash flow every single year, market volatility stops being a threat and becomes a strategic opportunity. That's a position of incredible power. Let's do some simple math. Imagine a company that earns $20 billion a year in pure free cash flow. During a market pullback, its stock price drops by 30%. What's really happening? You re-getting the chance to buy a piece of that $20 billion annual cash machine at a significant discount. You're buying its future earnings stream on sale. Over the next few years, as the market recovers, two things happen. First, those earnings continue to grow. Second, the stock's valuation returns to its normal, higher level. The investors who had the courage to buy when everyone else was scared are handsomely rewarded. And what about those who waited for certainty? They either end up buying at a much higher price, or more often they don't buy at all and miss the entire move. So your actionable step for this category is discipline. Pure, simple discipline. You only buy tech companies that are already profitable, have low or manageable debt, and are clear leaders in their specific sector. You have to learn to ignore the social media hype and the sensational headlines. Instead, you need to read their quarterly earnings reports, follow the cash. The cash flow statement is the ultimate source of truth. It can't be easily manipulated, and it tells you exactly what's going on inside the business, even when the headlines are trying to tell you a different story. Cash is king, and in investing, it's the kingmaker. Now, I need to address the single biggest mistake I guarantee most people will make in 2026. And in every market downturn for that matter, they'll tell themselves, I'm just going to wait. The biggest gains have already been made. Fear is the most expensive emotion in investing. Hesitation costs you real money year after year. I'm not telling you to be reckless or to blindly throw all your money into the market at once. That's gambling, not investing. I'm saying you need to invest intelligently and systematically. Build your positions in these high-quality companies over time. Their earnings are increasing, they're paying you income, and your ownership stake is compounding. That is how real, lasting wealth is built. So let me bring this all together for you. We're not here for hype. We're here to talk about real money, real strategies, and building real wealth. Remember this one thing above all else: your money doesn't grow by sitting still. It grows when you make smart, consistent decisions over a long period of time.